Welcome everyone to the Chartered Accountants Worldwide Network USA webinar. What's happening with IFRS accounting standards, which is presented by BDO. I'm Andy Moore, a principal with BDO in our IFRS group. So before we start, a few housekeeping items. So the handouts are available. You can download those from the icon at the top right of your screen. In terms of CPE, this webinar is CPE eligible if you've requested. To qualify, you'll need to answer the polling questions that will be asked during the webinar. There are going to be 4 polls during the webinar and a survey when you exit. You need to answer at least 3 polls to qualify and attend for at least 50 minutes. So the format of this webinar is a 60-minute presentation, including the introduction. And if you have questions, please note them in the Q&A tab on your control panel. We'll be recording this presentation and it'll be made available on the CAW Network USA website after editing and approval. So at the end of the event, when you exit, take our short survey and let us know what you think, and if you'd like to connect with the presenters today, leave a note and we can connect afterwards on LinkedIn or via email. So our learning objectives for today is threefold. So after the presentation, you should be able to describe timely IFRS accounting standards guidance, hot topics and resources and their general impact on the global accounting and financial reporting environment. Also, you're going to describe IFRS accounting standards updates that have occurred in the last 6 months and how they compare with the guidance in US GAAP, and also describe anticipated upcoming changes to the IFRS accounting standards guidance. We'll talk a little bit about the agenda in a second. So let me just get the first poll started. So I will launch that now. And then while I'm doing that, I'll introduce the team today. So firstly, Geoff Aldridge, who usually moderates for us, is not able to join us today. Geoff's our connection with the CAW Network USA, as well as being a BDO tax services principal. He's also president of the CAW Network USA Chicago chapter. So generally on these events, we tend to have up to 4 or 5 speakers, but today we've got a smaller roster compared to normal. So I'm just going to be joined by the one and only Oscar Ayala-Murillo. Oscar's a director in our global offering service team based in the US. He works in many BDO member firms on SEC related matters, including gatekeeper reviews for foreign private issuers with the SEC. Okay, so let me close the poll results now. Share the results. So most of the people, or a majority of the people on the call do have IFRS in there on their ongoing work day to day. So let's go to slide. Actually, before we do that, so let me just give 30-second plug on BDO. So we're one of the nation's largest accounting and advisory firms, generating over $3 billion in annual revenue. We've got more than 12,000 professionals across 70 offices across the US. And the firm delivers extensive reach and deep technical expertise in a number of service lines. So as a US member firm of BDO International, we have a presence in over 166 countries, and BDO provides a full suite of assurance, tax, and advisory services to both public and privately held organizations. Our breadth of services and industry specialization allows us to support complex client needs while maintaining a personalized, relationship-driven approach. Globally, we're the 5th biggest firm, and we take great pride in serving all our clients with exceptional client service. And everything that we do is rooted in people-first culture and helping people thrive every day. All right. So here's our agenda for the day. So in previous webinars, we haven't really touched on IFRS 18, which is a new standard that's coming out on presentation and disclosure in financial statements. So today we wanted to just talk through the key implications of that standard, which is a big change. And we kind of split it up into 4 key sections, which are the principal changes that are going on as a result of IFRS 18. And we've also got a section on transition and a short section at the end on resources. Okay, so let's go back to basics. So IFRS 18 was issued after the proper consultation periods in April 2024. The standard sets out the requirements for the presentation and disclosure of information in general purpose financial statements, with the aim to help provide relevant information that faithfully represents an entity's assets, liabilities, equity, income, and expenses. So the effective date is for annual periods beginning on or after January 1 of 2027. So this is a topic that we've talked about more broadly for a while, but it seemed like the date was always way off in the distance, but now this is coming. And so it's also important to remember that the first set of financial statements is going to require comparative periods to be presented in accordance with IFRS 18 too. So for many companies, 2026 information is going to need to be analysed in accordance with IFRS 18 in most cases. So it's definitely a topic to be aware of, and the impact on your company should be top of mind, so you're prepared for this change in the standard. So we've got a section towards the end on transition, which Oscar's going to lead, so I won't speak anymore on that topic. So here we've included a snapshot of IFRS 18 as it was published by the ISB. So overall, the aim of IFRS 18 is to improve how companies communicate in their financial statements with a focus on the information in the profit or loss. There are some associated amendments to other standards, so IAS 7, the cash flow statement standard, and the accounting policies standard IAS 8 as well. So overall, the aim is to improve financial reporting by requiring detailed subtotals in the statement of profit or loss, specifically the addition of an operating profit and a profit before financing and income taxes category. Also, for those where it's applicable, requiring disclosure around management performance measures, and also adding some principles around aggregation and disaggregation of information. So as you can tell from that, most of the changes are going to be statement of profit or loss focused, but there are some limited changes to the statement of cash flows and the statement of financial position as well. So what is IFRS 18? So it's the replacement to IAS 1, which was the standard that governed presentation of financial statements for many years. IFRS 18 is going to supersede IAS 1, and it will deal with the preparation and disclosure of financial statements. However, it's not going to change every single requirement in IAS 1, and many of them are going to be rolled forward unchanged into the new standard. So even though the changes being introduced by IFRS 18 are quite significant, don't think of it as a whole new set of standards. It's really just a focus on the presentation. And so what we've got on this slide is some examples of what's not going to substantially change as a result of IFRS 18. And so in these examples here, many of the requirements are moving straight across from IAS 1 into IFRS 18. So that's things such as the most primary financial statement requirements outside of the P&L, requirements around comparative information and offsetting, and classification of assets and liabilities as current versus non-current. You'll know there's an amendment to IAS 1 around that topic of current and non-current fairly recently, and that stays the same. That's not going to change. So then, having just been through what's going to stay the same, the main changes that are going to come around are the following. So firstly, the structure and categorization of statement of profit or loss, which I'll spend some time going through shortly. There's some mandatory and additional subtotals in the statement of profit or loss, which I'm also going to talk through. And then, as I mentioned before, we got management performance measures and some guidance around aggregation and disaggregation, which Oscar's going to lead the charge on both of those topics. Okay, so after that introduction, let's begin with the structure and categorization of the statement of profit or loss. So this is an example of a statement of profit or loss in accordance with IFRS 18. So to the right, you can see a column titled classification. So this isn't necessarily going to be presented in your financial statements, but this is just to help illustrate what we're looking at here. So IFRS 18 is going to require all items of income and expenses to be categorized into one of the 5 categories, that being operating, investing, financing, and then income taxes and discontinued operations. So items of income and expense that are generally classified into these 5 categories according to the nature of the item, and especially when there's an entity that doesn't have a specified main business activity. So we'll talk about that concept shortly. So these categories drive certain mandatory subtotals. So for example, operating profit in IFRS 18 is defined as all items of the common expenses which are classified in the operating category. So the aim here is to create consistency in how the subtotals are presented by entities, which has been a major concern of users historically. You know, IAS 1 have not a lot of specific requirements in terms of what P&L looked like. We'll look at that in a second. So IFRS 18 has certain exceptions to the general rule and classification requirements for entities that have a specified main business activity. So that's to say that for certain entities, the way in which the entity operates its business will affect how items of income and expense are categorised. So for entities with specified main business activities, certain items of income and expenses that would otherwise be classified in investing and or financing categories would drop into the operating category. So for example, if an entity has a main business activity of investing in a particular type of financial assets, then the fair value gains and losses on those assets measured through the P&L would be classified in the operating category. And that's to reflect that that is the main thrust of their business. So it's not trying to parse that out from the main operations. So let's discuss a couple of common questions. We've got revealed the answers already on here, but so the question one is that are the 5 categories labelled in the statement of profit or loss? So as I said in that previous example, we added that column, the classification column, just for illustration purposes, but on your actual financial statements, you're not going to see specific labelling of those items, or it's not a requirement for this to be specific labellings of those categories. So really the driver for the categories, as I said, is to ensure consistent calculation of the mandatory subtotals and therefore to generate comparability. So question 2 here is, are the operating, investing and financing activity categorizations consistent with IAS 7? And the answer here is no. So there are some differences, and the idea from the ISB was not to align these categories when they went through prepared the standard. So during the development of IFRS 18, there were some stakeholders that suggested avoiding using the operating and financing to avoid confusion with the cash flow, but the ISB determined in the end that the category labels that they proposed in the initial exposure draft would be fine. And so the final question on this tab is, how is the operating category defined? So it's important to re-emphasize that the operating category is a residual category. So meaning that items of income and expenses are always classified into the operating category unless they meet the criteria to be classified into another category. And that's from paragraph 52 of IFRS 18. So therefore, it's necessary for entities to determine whether each item of income and expense may be or is required to be classified into one of those other 4 categories. So let's talk about the first category here, investing. So except when an entity has specified main business activities, an entity classifies in the investing category specified income and expenses from certain assets, i.e. specified assets, which are listed in paragraph 53 of IFRS 18. And so that's going to be, if we look at the slide, the top section lists the different types of assets. So investment in associates and joint ventures, cash and cash equivalents, and other assets if they generate a return individually and independently of the entity's other resources. So you might think here about like an investment property, where it's not the main purpose of the business. We'll expand on that in a minute. So specified income and expenses generated from these assets are the type of income and expenses that may be classified in the investing category. So said another way, not all income and expense that relate to the assets listed in paragraph 53 may be classified in the investing category. And so which types of income and expense that are to be categorized in this category, I've said category a lot there, I apologize. This is defined in paragraph 54. So if you're looking at the investing topic, if you look at paragraph 53 and 54 of IFRS 18, that's where you're going to get your key guidance from. And so the standard includes some common examples of items that would generally be classified in the investing category for entities without a specified main business activity. So for example, for your investment in associates, you're going to see, sorry, bad example. So this kind of specified income and expenses is things such as income generated by those assets. So, interest from your cash and cash equivalents, your share of the results, and things like rental income if you've got an investment property. Also, when you think about the income and expenses from initial and subsequent measurement, you're going to see things such as depreciation associated with these specific assets or impairment losses as it relates to those assets, or indeed fair value gains or losses. And then the other thing you might see is incremental expenses directly attributable to the acquisition and disposal of those assets. So things such as transaction costs on financial assets at fair value through P&L, or cost to sell, like broker commissions, things like that. Let's just pause back and go back to depreciation for a second. So paragraph B47 of IFRS 18 notes that depreciation is an example of income and expenses that arise from the initial and subsequent measurement of the assets. However, this does not mean that the depreciation in general will be classified in the investing category. So for entities without a specified main business activity, only depreciation related to assets that meet the criteria in paragraph 53 may be classified in the investing category. Otherwise, depreciation is going to be an operating item. So want to be careful of and analyse carefully. So this flowchart helps to understand the criteria to classify income and expenses for entities without specified main business activities. Summarises the requirements in paragraph 53 and 54. And so this is a way to kind of structure your thinking and go from 53, the requirements to identify the assets, then think whether the associated costs do indeed meet the criteria here. So now let's move. If the entity invests in a particular type of assets or provides financing to customers, exceptions to these rules generally apply. However, we need to keep in mind that if an associate or JV is accounted for using the equity method, no exception exists, and that the income and expense associated will always be classified in the investing category, regardless of whether the entity has specified main business activities. So now you might ask, like, what might be an example of where an investment in associate wouldn't be equity method accounted? And this would be a good example of this would be where you've got an investment entity and they measure all their investments at fair value through P&L. So on the other hand, if the investment in associate or JV is always accounted for using the equity method, remember that it's always going to be in the investment category. So let's go through a couple of illustrative examples here. So the first one is entity A owns plant and equipment that it uses to manufacture widgets. It also owns a building that it rents out to tenants to earn rental income. So entity A accounts for the building that it uses for rental income as an investment property in the scope of IAS 40 and uses the cost model. It does not have any specified main business activities. So the question would be, what should be the categorization of depreciation on the property, plant and equipment, and then on the investment property? So we go back to that flowchart here. And so let's work. So if we work through this, we see that it's going to drop out into the operating category for the, as it relates to the property, plant and equipment, because it doesn't meet it's not meeting the criteria of a specified asset. And so then it drops into, the answer to the first question will be no, and you drop into the non-specified assets. And in that case, you go across and it's an operating expense. So then let's think about the depreciation on the investment property. And then this is assuming that the cost model is applied here. So in that case, you'd look at the specified assets and you'd say, okay, this is it's an asset that could generate a return individually and largely independently of the entity's other assets. So then you would go and say yes, you move across to the right, and you would say, is the income or expense specified in paragraph 54? And it would be part of the income and expenses that arises from the initial and subsequent measurement of the asset in accordance with paragraph B. And so in that case, the depreciation on the investment property would be in the investing category. So let's go through another example with the same facts. However, this time, let's think about the expenses. So entity A incurred for cleaning and maintenance fees on the investment property. So how are those handled? So again, we go through the flow chart. It's in C here, it's an asset that the investment property is an asset that can generate a return individually and independently of the entity's other resources. But then the question is, does it meet the criteria in paragraph 54 as an income and expense? And so actually in this case, it doesn't, because the cleaning and maintenance fees are not income generated by the assets, and it's not an income or an expense that arises from the initial or subsequent measurement of the assets. It's a cost associated with it, but it's not associated with the measurement of the asset. and then it's not an incremental expense directly attributable to the acquisition or disposal of the assets. So therefore, the cleaning expense as it relates to the investment property would actually be in the operating category. Okay, so let's pivot now to the financing category. So in the financing category, it's necessary to look at all liabilities in the financial statements and categorize them into two buckets, so to speak. There are those liabilities that arise from transactions that involve only the raising of finance, so pure financing liabilities, and then there are other liabilities. So based on the category the liability falls into, then the income and expense related to those liabilities are categorized based on a set of principles that I'm going to explain in the coming slides. Okay. So as IFRS 18 requires only a binary assessment of whether a liability arises from a transaction that involves raising of financing or not. So it's a binary assessment. So that's a key gating question as you go through. So IFRS 18 requires an entity to identify liabilities that arise from transactions that involve only the raising of finance. And in such transactions, an entity receives finance in the form of cash or an extinguishment of a financial liability, or the receipt of an entity's own equity instruments. And at a later date, it's going to return the liability in exchange for cash or its own equity instruments. So IFRS 18 gives several examples of these types of liabilities, and obviously a typical debt instrument that's going to be settled in cash, or things like a supplier finance agreement arrangement when the payable for goods or services is derecognized and the entity is discharged of the financial liability for the goods or services and has to return cash in exchange. So IFRS 18 states that specified income and expenses that arise from these types of pure financing liabilities should be classified as financing activities. So examples of those are things such as interest expense, income and expenses from the derecognition of liabilities, dividend on shares issued that are classified as liabilities. So again, a useful flow chart, and this is, I'll give a promotion for it later in the webinar, but there's a BDO publication available called IFRS 18 in Practice that has a ton of these useful flowcharts, case studies that would really help with you as you go through the initial adoption. So for pure financing liabilities, the requirements are relatively simple. So all related income and expenses from those liabilities are classified in the financing category. So this is quite broad, and you can think of a bank loan as a common example here. So there are many types of income and expenses that arise from the bank loan. So these would include the interest expense, but also things like the modification, a gain or loss, or a gain or loss on the extinguishment of a financial liability. There are some exceptions to this rule around foreign exchange gains and losses, and there's some special considerations where you've got hybrid financial instruments, but we're not going to go into those today. But if you have those instruments or those fact patterns, then it's something to look into in more detail. So for other liabilities that aren't directly financing, the requirements are more restrictive. So not all income and expenses from liabilities are going to be classified in the financing category. So for other liabilities, income and expenses are only classified in the financing category if they are interest income and expense or income and expense from changes in interest rates, and those items identified by applying applicable IFRS standards. So any other income and expense must be classified in the operating category. So just conscious of time here, so I think we're just going to talk through a couple of examples. So one of them would be, just before we go into this example on screen, so one of them would be if you've got a modification gain or loss on a lease liability. So IFRS 16 paragraph 46 requires a lessee to account for a lease modification that's not accounted for as a separate lease by decreasing the carrying amount of the right of use asset with an amount recognised in the profit or loss relating to the partial or full termination of the lease. So that gain or loss recognised in the profit or loss must be classified in the operating category, because such a gain or loss is not interest or expense. So it doesn't meet the criteria in IFRS 18, paragraph 61. So maybe then we'll talk a little bit about legal provisions, which is what this example here is talking about. So where you've got changes in estimates related to a legal provision, IFRS 37, paragraph 45 to 47, requires that a provision reflects the time value of money when the effect is material. So paragraph 59 of IAS 37 requires that a provision be reviewed at the end of each reporting period and adjusted to reflect the current best estimate. So therefore, from one reporting period to the next, the change in the carrying amount of the provision that is discounted is going to reflect two things: the unwinding of the discounting as time passes, and then also any updates based on the current best estimate of that legal provision. So while IAS 37 does not specify the presentation of these two items in the statement of profit or loss, diversity in practice does exist, and these two items will generally be reflected in different categories in the statement of profit or loss. So, for example, specifically here, Entity B recognises the provision of currency unit 100 as at December 31, 20X7 for a legal settlement. So liability is discounted to reflect the time value of money. A settlement is not expected for several years. So if then fast forward a year, as at December 31, 2X8, Entity B has revised its best estimate for the legal settlement, and the carrying amount of the provision is now up to currency unit 125. So the question really is, or the thought is, if we assume that the total adjustment of currency unit 25 is attributable to two things: one, the unwinding of the discounting as time passes, so that's 8 currency units, and then 17 currency units reflecting a change in the best estimate of the legal settlement. Okay, so let's walk through what that looks like on the next slide. So we start off on the flowchart by looking at the requirements that apply to all the liabilities, those that are not pure financing. So here we look at the currency unit 8 that related to the unwinding of the discounting. So that's going to be a financing category item because the legal provision is a liability that arises from a transaction that does not involve the raising of finance, but it is interest income and expense. So that would be sit in the financing category. But on the other hand, the 17 currency units related to the change in the legal provision would go through the operating category because it doesn't meet the other criteria. So it's really important when you look at a change in measurement of liabilities, especially those that have been discounted, to think about the split and where the movement should be posted. Okay, so we got a poll here. So let me open that up. All right, we're getting up to 80% participation. So I will close the poll in 5, 4, 3, 2, 1. So then I'll share the results, and it's absolutely right that there was the majority of people said IFRS 18 is going to have some kind of effect, and there's going to need to be, it may vary in size, but it's definitely worth, you've got to go through the analysis to identify the issues. All right, so with that, I'll hand over to Oscar to speak on the aggregation disaggregation guidance.
Oh, thank you, Ali. I appreciate that. Now let's briefly talk about the principles of aggregation and disaggregation. So when we talked about the aggregation guidance in IFRS 18, we're referring to that the primary financial statements should provide a useful structure summary of a reporting entity's assets, liabilities, income and expenses, and cash flows. And when comparing IFRS 18 with IAS 1, IFRS 18 now has a more specific requirements that are applicable to the roles of the primary financial statements and the notes, and how the entity aggregates and disaggregates that information more generally, and the use of labeling compared to IAS 1. Now, the extent to which companies must change their existing presentation in IAS 1 will depend on the entity's precise facts and circumstances. So today we'll briefly discuss those rules and look more specifically at the roles of the primary financial statements and the notes, the principles of aggregation and disaggregation, analyze of how or the most useful structure summary of all the operating expenses and the description that are being used. Next, Andy. So if you look at paragraph 16 and 17 of the guidance, it specifically defines the roles of the primary financial statements, and the intention is here to assist companies in determining whether or not to include information in the primary statements or in the notes. And before we go into a lot of detail here for the rules, I think one thing is important is to understand that in simple terms, right, plain English, what that standard means by useful structure summary. And a structure summary is the sort of structure that is provided in a set of financial statements that is and will be useful for one, obtaining an understandable overview of the entities, recognized assets, liabilities, like we said, equity, income and expenses, and cash flows. Secondly, that information will be useful for making comparison between entities and between reporting periods for the same entity. And third, useful for identifying asset items or areas about which users of financial statements may wish to seek additional information in the notes. Next. If we go to paragraph 41 of the standard, it provides guidance to help the users determine how to aggregate or disaggregate information in the primary financial statements. And these are listed here on the slide from A to E. But in order to meet that requirement of paragraph 41, companies must always disaggregate items whenever the resulting information is material. However, this disaggregation need not always be in the primary financial statements, as it may also be provided in the notes to those financials. And this is not sort of like a free choice by entity. So companies must consider the roles of the financial statements in determining where to provide that information about that material item, and always sort of bear in mind that need for information to be presented to be that sort of definition that we just talked about, useful structure summary. And one important note here to mention is that we may run into certain scenarios where IFRS accounting standards may require specific line items to be presented in the primary financial statements. And this is where judgment is applied. And a company may come to that conclusion where that presenting certain line items separately in the statement of profit or loss may not be necessary because of amounts being immaterial. However, this has to be assessed on a case-by-case basis. Next. Here are a few examples of income and expenses, as well as asset liabilities and items of equity that may warrant a separate presentation in the primary financial statements or disclosures on the footnotes. But as we talked about, keep in mind materiality, as well as the need for the information to be presented as that useful structure summary. Okay. Next. Now, whether an entity is determining how to aggregate or disaggregate that information in the statement of profit or loss to provide that structure summary of the income and expenses, or how to aggregate or disaggregate more information generally, there's always going to be judgment being used. And that judgment is based on certain characteristics of a particular item of income or expense or liabilities and assets. So those characteristics are here listed on this slide, like nature, function within the company's business activities, for example, frequency of the item of income or expense, and whether or not it's a recurring or non-recurring item, as well as the measurement basis and the size of the item. Okay. Next. Now, in the operating category, an entity should be classifying and presenting expense in line items in a way that provide that structure summary. And this can be done based on the nature, function, and with a mixed presentation, as we've sort of already know, right? And this is what IFRS, or where IFRS 18 paragraph B80 comes into play in determining what should be considered when assessing which presentation to use. And the first thing is, what line items provide the most useful information about the main components or drivers of the entity's profitability. So that has to be in the front mind for that determination of what should be considered within the standard. Also, what line items most closely represent the way that businesses manage and how management reports internally, or what standards industry practice entails, and whether or not that allocation of particular expenses to function will be arbitrary to the extent that line presented will not provide really a useful, or a faithful representation of the function. So these requirements to present the operating expenses by nature, function, or mispresentation only applies to that operating category. So do not confuse that. That would apply to the other 4 categories that Andy was talking about earlier, like investing, financing, income taxes, or discontinued operations. Okay. And one method, or once the method of the presentation is selected, and I think this is very important, is that the companies are required to maintain a consistent method of presentation, because this is because the method basically selected is considered to be an accounting policy. Next. And as we discussed just now, companies are required to provide all descriptions and explanations that are necessary for those users to understand the item. But in some cases, this may be quite simple. So for example, when you talk about utility and expenses, however, in most cases or certain cases, a judgment will be required. And this is where that label other comes into play, either because a more informative label cannot be found or the amount is immaterial. And if that's the case, paragraph B26 of the standard requires additional disclosures. And more specifically, companies should use a label that will describe the aggregated items, such as other operating expenses, or if the items are the accumulation of immaterial amounts of different nature, then an appropriate label cannot be added. Maybe additional narrative and disclosure should be added to the notes. Okay. And with that, I'll pass the presentation back to Andy to talk about the subtotals. Okay, and we'll be back.
Okay. All right. Thanks, Oscar. So let's go on and talk about the totals and subtotals. So I think the best way to see how this will impact the statement of profit or loss is to look at an example. So this example is going to look familiar, similar to the one I used when I set the scene in the categorization section earlier. So, but as we look more carefully at this, it includes a mixed presentation for operating expenses. So we're used to seeing presentation either by function or by nature under IAS 1. IFRS 18 permits the use of a mixed presentation when the preparers review the factors in paragraph B80 of IFRS 18 and determines that a mixed presentation provides the most useful information for the user. So with that in mind, we therefore see cost of sales in this example, which is a presentation by function, while at the same time we're seeing selling expenses, the research and development broken out below gross profit, which is more by nature. So a mixed presentation also requires appropriate labeling to be used, or else line items may be misleading. So it's not quite the case on this slide, but for example, if an entity presents cost of sales with all other expenses classified on the basis of nature, then certain expenses classified in cost of sales, for example, salaries and depreciation that are embedded in there in the cost of inventories, whilst you're going to have other elements, salaries, and which may be broken out separately. And so really the need is for the financial statements to include a reconciliation, so a user can see the total costs for things such as depreciation and salaries, and that the user can understand where they sit on the face of the P&L. So as noted in the example, certain line items are mandatory and others are additional. So you can see obviously we've got the operating profit, which I've mentioned as being a new mandatory subtotal, and then the profit before financing and income taxes, which is another mandatory specified subtotal. But then we've also got the additional subtotals, which aren't required by the standard, but in this example, and in many cases, they'd be deemed to be giving a useful structured summary. And so profit before income tax is a common one that we all see. So while there are a couple of mandatory subtotals introduced by IFRS 18, the standard does also require entities to present additional items and subtotals if, as I just said, if it provides a useful structured summary. So paragraph 24 of IFRS 18 requires that any additional line items or subtotals must meet this criteria. So they must comprise amounts that are recognised and measured in accordance with IFRS. It must be compatible with the statement structure in IFRS 18. It's got to be consistent from period to period and be displayed no more prominently than the totals and subtotals that are mandatory per IFRS 18. So paragraph 24 is not optional, so those criteria must be met and considered when analysing what a useful structured summary is. So additional subtotals may be presented within other subtotals, including those required by IFRS 18. So for example, operating profit or loss comprises total income and expenses classified in the operating category. However, there may be other subtotals within that, such as gross profit. And as long as that can be demonstrated to meet the criteria in paragraph 24, then those subtotals are fine to include. And obviously you see certain industries where you have certain subtotals such as gross profit that are typical, and so including them meets the criteria. And so the IASB considered whether to directly define EBITDA, which is a commonly used measure in communication to users of financial statements. Overall, they concluded that no consensus exists as to how to calculate it, and so they didn't want to wade in on that debate. So instead, IFRS 18 paragraph 118b exempts operating profit or loss before depreciation, amortization, and impairments within the scope of IAS 36 from the management performance requirements in IFRS 18. So this subtotal is similar to EBITDA in that it's comprised of operating profit and excludes taxes, and it also adjusts out depreciation and certain impairment expenses, but it's not trying to be, or it's not claiming to be, a universal definition of EBITDA. Okay, so let's launch the next poll here. I will close the poll in 5, 4, 3, 2, 1. Okay, so sharing the results here. Yes, I mean, I agree. Other should only be used sparingly, and it should always be an effort to be as clear as possible with what's in that other category, obviously with reference to materiality. All right, so with that, I will hand back to Oscar to talk about management defined performance measures.
All right, Andy, thank you. All right, so Andy talked about subtotals, so let's bring that a little bit more into that management defined performance measures. And this was introduced, the key concept was introduced by IFRS 18. And the reason we want to discuss this topic is because IFRS 18 now includes certain disclosures requirements that are related to MPMs, or management defined performance measures. So let's dive a little bit more into this topic. So IFRS 18 defines MPMs as subtotals of income and expenses that the entity uses in public communications outside the financial statements to communicate management's views of an aspect of the financial performance of the entity as a whole. So the definition of MPMs in IFRS 18 is limited only to those subtotals of income and expenses. Therefore, subtotals of income and expenses that are specifically required to be presented or disclosed by IFRS financial accounting standards are not MPMs. And IFRS 18 paragraph 118 will also list certain subtotals of income and expenses which are deemed not to be MPMs, and we'll talk about those later. But one important point to clarify here is the difference between non-GAAP measures or alternative performance measures and MPMs. As an SEC sort of reviewer, you start thinking about MPMs and right off the bat, you start thinking about non-GAAP measures. But MPMs here are defined by IFRS 18 as a subset of those alternative performance measures, because they provide insight into how the business is managed and how management views the entity's financial performance. However, the main difference between MPMs and these non-GAAP measures or alternative performance measures is that those disclosures have generally been containing outside of the financial statements. So for example, when you look at management discussions and analysis, MD&A, strategic reports, for example. But now IFRS requires disclosures related to MPMs to be included within the financial statements in a single note. So that's a big difference, right? And interestingly enough, now for entities that are subject to audit, these single MPM notes will also be audited, which could be also a significant change in practice for many of the companies where that non-GAAP information was usually traditionally placed outside of the financial statements. So keep that in mind. Next. Here we have an examples, and I think Andy talked about it when talked about the totals of income and expenses, which are considered to be MPMs: adjusted profits, adjusted operating profit, adjusted earnings before interest, tax, depreciation, and amortization. Now, it is also important to know that for each MPM, IFRS 18 requires an entity to disclose information, including a description of the aspect of that financial information communicated by the MPM, as well as the method of the calculation of the MPM and reconciliation between the MPM and the most directly comparable subtotal that is specified by IFRS 18 or other IFRS accounting standards. Next. Now, IFRS 18 requires to disclose information about all its MPMs in a single note to the financial statements in order to provide information to help the users of the financial statements understand, one is the aspect of financial performance that in management's view is communicated by an MPM, as well as how that MPM compares with the measures defined by IFRS accounting standards. And as such, I think IFRS 18 lists several disclosures to be made, and these include: one, how the measure is calculated, how it provides useful information, and why management believes that MPM provides useful information about the company's performance, how the performance measures are also comparable to MPMs of other entities, and a reconciliation to the most comparable subtotal, as we talked about. One important point as well is the effect of the non-controlling interest and income tax for each item disclosed in the reconciliation. So we'll see that example later on. And a few key reminders that relates to disclosures, right? It is not permitted to disclose the information to MPMs by cross-referencing other notes in the financial statements. So all disclosures have to be made in a single note. And that single note on MPM's disclosure is required to include a statement that those measures are provide management's view of an aspect of the financial performance of the entity as a whole, and also that are not necessarily comparable with measures sharing similar labels or descriptions that are provided by other companies. Also, companies are required to label and describe each MPM in a clear and understandable manner that does not mislead users of the financial statements. I mean, same thing when you talk about non-GAAP or non-IFRS items. And if the method of calculating the MPM differs from the accounting policies that are applied in the statement of financial performance, now IFRS, and specifically paragraph B 134, requires that the specific disclosures include the fact that the method of the calculation of the MPM differs from the accounting policies applied, and also describe the calculation that was used for the MPM. Next. Now, as stated before, as we started talking about this, to meet the definition of MPM, a subtotal of income and expense is required to be included in public communications outside the financial statements. And for this, paragraph B 119 provides a non-exhaustive list of which public communications will be considered to be included or excluded from the definition. So communications included within the definition, like you see on the slide here, are management commentaries, press releases, and investor presentations. And excluded from that will be social media posts, written transcripts of oral communications, and oral communications themselves. Now, note that if an entity or companies make no public communications based on the list here outside of the financial statements, they may not have any NPMs to disclose. So this could be the case for many private companies here to apply IFRS accounting standards. Okay, so important point. Next. And to make it a little bit easier to understand, the flowchart summarizes the requirements for identifying management-defined performance measures as set out by paragraph 117 to 120. And starting from top left, for identification of NPMs is the measure of a subtotal of income and expense. And if the answer to that is no, then there is no NPM. But it's yes, then we go to the next question. Is the measure used in public communications outside of financial statements, as we just talked about? If the answer is no, then hey, no NPM is required. And but the answer is yes, then is there a measure listed in IFRS 118 or specifically required to be presented or disclosed by any of the IFRS accounting standards? And if the answer to that is yes, then the entity needs to find out what that measure is and communicate that on the financial statements, as we talked about. Okay, so this is a very helpful chart to look when deciding whether or not an NPM is required. Okay, next. Let's now talk about an example, and this is a very simple example, but it sort of encompasses what we just talked about. And the company here in this example uses the following management-defined performance measure in the public communications: the operating profit or adjusted profit before non-recurring expenses and gain and losses, and the profit from continuing operations before non-recurring expenses and gain and losses on disposals of property and equipment. Okay, so management statements disclosure in accordance with IFRS 18 paragraph 122 is that these measures that we just talked about, right, the operating profit or adjusted profit or profit from continuing operations, provide management's view on certain aspects of the financial performance of the company as a whole. The measures are not specified by IFRS accounting standards and therefore may not be comparable to other similar measures. And to provide management's view of the company's financial performance, the types of adjustments have to be made for operating profit and profit from continuing operations. So we have those here. One of them is non-recurring expenses. Now, operating profit or profit from continuing operations have been adjusted for items of expenses that the company does not expect to arise for several future annual reporting periods. So these are here impairment losses, for example, restructuring expenses, or gains on disposals of PP&E. And based on the example, the company or management believes that adjusting operating profit and profit from continuing operations from such items will provide information that is helpful in understanding the trends in the company's underlying profitability. If you look at the bottom of the slide, you will see that management description of the aspect of financial performance that is communicated by the NPMs, and the explanation as well as the description of how the item contributes to the NPM, and providing a, at the end of the day, useful information for each type of the adjustments, right? And as a way to recap of what we sort of discussed briefly is, if you have a look at the example, it clearly discloses, one, how that measure is being calculated, right, from the columns, how it provides useful information, and why management believes that that NPM will provide that useful information about the performance of the entity, profitability most in this case, how the NPMs are not comparable to other entities, and the effect of the non-controlling interest an income tax for each of the item disclosed in the reconciliation. So you will see those two lines right there of the profit attributable to non-controlling interest and the income tax expense and its related adjustment. Okay. So with that, let's move on to the next topic, and the next on. Oh, we have a polling question.
Okay, and then we just think, I think we're in the final furlong there, the short section on transition. I'm just going to do a quick countdown. 5, 4, 3, 2, 1. Okay, and good proportion of people got that right.
Awesome.
So then let's get into the transition real quick.
Okay, so transition, and this is the last topic that we'll talk about. Okay. And we've discussed before, but I just want to expand on the effective date and how that will look in practice. And this slide shows the sort of first period and that IFRS 18 will be effective for, depending on the company's year-end date. So earlier application is also permitted, right? As a reminder. But it is imperative for companies to start thinking about the implications of how they will gather and manage data in order to meet that new reporting requirements. And when applying that IFRS 18 for the first time, right, entities must do it retrospectively, which means that they have to restate those comparative periods that are being presented. So as an example, for December 31st, 2027 year end, that December 26th comparable will be required to be restated. And as discussed earlier, the impact of adoption will mostly be seen on the statement of profit or loss, right? But also the primary statements that will be affected as well, along with the notes. So this is not just a simple task of restatement, right? Or moving some numbers around. Next. And depending on the level of complexity of an entity, the time and effort that are involved in the transition into the requirements of IFRS 18 may vary significantly. So for complex operations, particularly large groups, systems, processes will need to be developed around some areas. Classification of items of income and expenses into the categories, assessing the impact of the new requirements applicable to foreign exchange differences, for example. Assistance may not capture foreign exchanges by individual assets or liabilities. The determination of the appropriate level of aggregation and disaggregation, as we talked about in the primary financial statements and notes, and assessing the effect of other requirements that are modified by IFRS 18, like NPMs and impacts on the statement of cash flows. So that was brief, but let's just wrap up the presentation with a few list of resources. So Andy, take it away.
Great, thanks, Oscar. All right, so I touched briefly on this IFRS 18 in practice publication. So you have your handout. So there's a link in the handout here that will take you to that publication. It includes a lot of the flow charts and case studies that would be really helpful in that initial year adoption, especially. And then we've also got the range of BDO publications on model financial statements and in practice guides, which are all extremely user-friendly and full of examples. A quick plug for our IFRS quarterly webinar series here. The registration link is on this slide. And also, if you need US GAAP CPE, we have a quarterly webinar series, and there's a couple of dates left upcoming that will be applicable. All right, so I think that's just about it. One last plug. So the next webinar is on price wars, and it talks about how to grow your practice and fees, and that's on April the 7th. All right, with that, I will say goodbye and thank you for your time today.